These are my favorite kind of trading days. The macro can go to the background. We can spend a little time on businesses. Jamie Murray, head of research at Murray Wealth Group. You like these days too, where you could just talk about actual stocks?
Every day in the market's a fun day.
It is. So let's talk with some of the ones that we've got our focus on today. Birchcliff is one of them. Not a surprise that they cut the dividend, but investors, I guess, disappointed nonetheless.
Definitely. Anytime you see these companies with high dividend yields like Birchcliff, there's a segment of the investor base that's just there to collect that dividend. And when that gets cut, you get selling. And so that's what we've seen. But Birchcliff, it's been pretty well telegraphed. We think that the dividend needed to come down. I think the bigger news was that the reduction was a little bit bigger than expected, and the production outlook was maybe a little disappointing as well.
So, you look for these opportunities that are beaten up and unloved. Is Birchcliff starting to qualify?
I think so. Birchcliff is not a name that we own currently. We like Whitecap, which is another company that has a higher dividend yield right now. We think Whitecap's dividend's a little more sustainable, and if commodity prices can hold in at a level, they'll be able to move through this weaker commodity price environment. But definitely, the whole space is getting more attractive. You want to buy low, sell high, and it's when this bad news starts to get priced in and then comes to fruition that these opportunities. And so Birchcliff, we think, is a much more attractive company to buy today than 3 months ago. So.
Interesting. Another stock that 3 months ago was definitely on sale was Dye & Durham. And it hit, I believe, a multi-year low. Since then, it's rallied quite a bit. And they're using that little rally as an opportunity to raise money. And it seems like it's going well because they priced at $12.10. They're trading above that. Is this a name that you like?
So this isn't a name that we own either, but I think last time I was on the show, I don't know if the reviewers remember, but we were talking about how these transactional companies should see better revenue with the move down in interest rates. And so the rate outlook has improved Dye & Durham's outlook, given that they have A, high debt, and B, they're tied to mortgages in Canada and the UK, so lower rates is good for them. This move up that we've seen, we think is justified, but I think there is a little bit of surprise that they're raising money, given they were buying back shares at a much higher price just a year ago. But this is going to remove some of the debt overhang, so we would think it's a neutral to the stock.
Well, because the debt became all of a sudden very important, right? This is a growth by acquisition company that said, and that marked the bottom, that we are going to start actually maybe shedding some non-core assets. So instead of growing, maybe shrinking or right-sizing.
Yeah, and so, I mean, this deal, I think, is just part of that strategy maybe accelerating it a little bit. But anytime we see a company selling stock, particularly not to fund an acquisition, there is that question of, well, does the management team think that if this is a good time to be selling, issuing equity, maybe the price is the right price to do that, and maybe they don't see as much upside in the stock in the near term.
All right, we'll keep an eye on that. I mentioned we're also tracking a bunch of these insurance stocks. Humana today, again, calling out medical costs. United Health did this a week or two ago. So there's something going on with these insurance companies. They're seeing higher medical costs that they have to pay out.
Yeah, and so this is, as you said, United Health dealt with this as well, and it's hitting the sector again today. United Health is the one that we own in the sector. I think if you look over the long term, it's had great growth. It's done a great job adding new members and shifting to the value-based care method, which is reimbursing for overall quality of care, not just on a per test or per unit basis that the U.S. healthcare suffered from before. And so we still like the stock long term. We think there's a lot of growth ahead, but when we see these increases in expenses, it really just means that the members are using the insurance more and that they're having to pay out more. And we think it's generally a cyclical dynamic, and it'll level off back to historical averages, but certainly in the near term, it's a little bit of profit pressure.
And the thesis around insurance stocks always is they might get a year wrong, right? They might misprice what their medical costs are going to be. They'll catch up next year. They'll probably raise how much they're charging, and often those prices don't go down from there. Can United Health do that?
We think so. The other issue with this year in particular is it's an election year in the U.S., and these companies are always in the crosshairs heading into the election. So I think there is a little bit more general anxiety about these names, particularly given that dynamic. But certainly we don't see anything changing the medium to long-term outlook. So as you said, we think that these companies will recover. the profitability and growth will be restored, and they'll continue to move higher over the future years.
Before I let you go, I want to give you a bit of a victory lap on Aritzia. That stock obviously did not do well in 2023. No. You were saying this is a buying opportunity, and then they reported their quarterly results, and that's exactly what it turned out to be. You saw a big pop in the stock. Still has a long way to go if you are a long-term shareholder, if you got in during the pandemic, but it felt like that was a really meaningful moment when they reported those results.
Yeah, so I mean, the stock's up about 30% since then, and almost 50% off the low. Certainly the general sentiment in the economy's helped. But the results really just took out that the worry that, oh, maybe the brand is irrelevant or dying. We've been arguing that they still have had very strong sales productivity. Their sales per store location was still much higher than 3-4 years ago. It was just sort of plateauing at a high level after years of very strong growth. Now we see that growth reaccelerating. They're going to open up 13 new locations in the United States and some larger flagship stores in the U.S. So that's going to accelerate growth in 2024. The one caution on the move is that, as I said, it's up 30-40%, but we haven't seen the estimates for 2024 and 2025 start to move higher. So it's all multiple expansion that we've seen in the last 2-3 months. And that does give me a little bit of pause in terms of an entry point. You want to buy it before the 50% move. Now I think if you're a holder, we've trimmed it. We still own a nice position. It's still one of our largest holdings. But certainly take some profits. The easy money, I would say, has been made. And now they have to show that they can execute again, get the margins back up, get the growth reignited. And so that's going to be the question for the next year.
Okay, so let's try and find the next Aritzia, the next 50% move, your high conviction idea. Leave us with one.
Sure. So our highest conviction idea right now, or one of them, I think, is Air Canada.
Oh. And
so Air Canada, obviously, it had a tough 2023 from a stock price perspective, but they had a phenomenal year financially. If you look at they blew out earnings estimates every quarter, and the stock really fell first on oil price concerns. When the oil price was high, that's going to eat into profitability. And now we're worried about the Canadian consumer.
And the other airlines have come out with warnings.
Sure, and in the U.S., we've seen warnings, but the U.S. is a different market in that the capacity growth came back much quicker. Canada, we're still below capacity that we had in 2019 for the general aviation industry, but demand is back to where it was. So we're still in a beneficial supply-demand environment for these companies. And even in a recession, airline demand doesn't fall off too much. Generally, what you see is capacity growth continues to grow while demand flatlines. But since we're still below capacity, we still think that there's a great year. The stock is dirt cheap, and the free cash flow is going to be used to repay debt. We see 30% this year.
Such a penalty box for this name. I wonder if I can ask the control room to do a 5-year chart, because you mentioned that they're doing record numbers, right, in terms of sales, and the stock is just a fraction of what it was before the pandemic took hold. Now, you could argue that it was maybe getting a little bit ahead of itself during that time, but you haven't seen any kind of re-rating to anything close to those levels.
No, it's really kind of traded in a range for the last 3 years. And they did take on a ton of debt to get through those lockdown days, but now they've mostly paid that off. We've seen the EBITDA come back to a historical level. So it's really back to the position that it was in 2018, 2019. Now the stock was $50 then, now it's $20. I mean, there's been a little bit of dilution, but we think it's also trading at a much bigger discount to the U.S. airlines too. We think it's a less competitive environment in Canada. Trans-Pacific travel's still recovering, and that's going to benefit them.